Happy Wednesday. Happy holidays, everybody. Thank you so much for joining us today, where we are going to really dive into showing you some examples of actual assets in our portfolio that play out, showing you our process, how we do what we do, and the outcomes. My name is Lauren Wells, joined by Chris here today, and just kind of some initial housekeeping things. Again, if you have any questions, please drop them in the Q&A. I'll be monitoring that as we go throughout, and we will get to every single one of them. So that being said, we will go ahead and dive right into this.
So, who we are and what we do, Lauren and I put together an experienced team with a proven track record and deep industry knowledge. Now, we're mission driven and we focus on transparency, integrity, and creating that win win solutions for investors and borrowers. As an engineer, I like to be focused and have our team be focused, especially on note investing. That is exactly what we focus on. We don't do multifamily, we don't do self-storage. We strategically focus on note investing. And today we're going to illustrate this further by sharing how our experienced team has that proven track record of delivering to our investors through the case studies we're going to show. So that's who we are and how we do it. As we mentioned, we invest in the mortgage notes. And today you'll hear Lauren talk about fix and flipping mortgage notes. And that's, I think, a term that will really stick with you in regards to understanding what it is we do. So with that being said, let's talk a little bit about our backstory. Go ahead, Lauren.
Yeah, so for those of you just joining us for the first time today, or maybe you've joined one of our other webinars where we didn't talk about this, and for those of you that have heard the story, thank you for listening in again. My name is Lauren. I actually started in corporate software sales right out of school and was also volunteering for a local water polo team. And what I realized was that a lot of the parents who were attending everything, now granted, I was not a parent at the time, were either investing in real estate or own their own business. Growing up, I came from parents who were always around. And so I wanted to be that. I wanted to be at the practices. I wanted to be at the games, involved in school activities for my kids. And so I started, again, not having kids at this time, thinking forward. I started investing in real estate, attending webinars like this, learning about self-directed IRAs, evaluating the different kind of asset classes, I guess you could call it, from fixing and flipping vacation rentals, long-term rentals, wholesaling, all the things, Airbnb, and landed on mortgage notes, at which point I built a little portfolio of my own, started doing that when I met Chris, who was speaking at a conference, and started working with him on some previous funds. And what we realized was that there are a lot of people that want access to something like this in a passive manner, don't necessarily want to be active, because when I got into this thinking it was passive, it is much more active than I ever could have imagined. So realizing that we had a lot of people who wanted to do joint ventures that may not have been accredited, or didn't know where to find passive income in this specific asset class. And so that's what kind of brought us together to launch our offering that is available and accessible to everyone.
Thanks, Lauren. Yeah, how we got here, I think, is a fun story and also gives insight about more about us. For me, I went to school for civil engineering, and that has given me that foundation for problem solving skills. To age myself a little bit, I've been in real estate since 1997, and over those years, been able to apply a lot of the skills through building some really cool projects, but also being able to witness 2001 when we had that tech bubble, 2008 with the financial crisis, and even today where we have that interest rate environment, which has caused a lot of chaos. And these challenges have taught me one critical lesson about how Lauren and I run this company, which is what worked yesterday or even today may not work tomorrow. And we're always ready to adapt. So how's this relate to you? Well, for me in 2013, I needed to build a nest egg, and my wife and I shifted to a real estate portfolio, and we started fixing flipping properties, which is buying a property which needed work or rehab and increasing its value by upgrading that property, which, as Lauren mentioned, it's very labor intensive, it's demanding, and trying to balance a W-2 while doing this, it was just too much. And for many people who are in real estate, that's very familiar. And that's when I discovered note investing, which allowed me to leverage my lessons learned from real estate in those past challenges and applying these skills and experience to a more sustainable model. And Lauren and I, wanted to bring this balance into note investing because, as she mentioned, finding the time to actively invest is a struggle. It's hard. And we wanted to be able to provide investors an opportunity not correlated to the stock market, interest rates, and passively invest in a company like 70.
So as we mentioned, that kind of brought us to our mission, which is really democratizing investment opportunities while providing win-win solutions for both borrowers and our investors. And that's really what we're going to focus on today, is kind of how that mission plays out in what we do, creating the wins for, again, our investors and borrowers alike.
Yeah. And as I mentioned, we put an experienced team together. We've managed over 600 plus deals, property values over $100 million. We've invested across the US and have had 5 prior offerings that we have an investor track record report by a third-party company that we're happy to share. And we've been able to do this and be successful, I believe, because of our vertically integrated team, meaning we have everything. We are the GP. There's no co-GPs within this offering, and our team are employees within the company that know our offering. Now we'll talk about impact investing with mortgage notes, and I'll let Lauren talk about more about how we actually make money in note investing.
So we'll talk more in depth about this, and Chris will go into more detail in the next slide. So I'm going to keep it pretty high level here, but we talk a lot about fixing and flipping is what we do when we just apply that strategy that most people are familiar with to mortgage notes. So we're buying these loans on single family homes at a discount to their balance. Then we really go through 2 separate kind of, I guess you could say, processes, where the first is we negotiate a payment schedule with the borrower, bringing them to the table to work with us, which then generates revenue from those payments, and then flip it. So we took it from non-performing to performing and flip it for a profit on the secondary market by either selling on secondary market. The borrower can also sell and pay off the loan, or refinance and pay off the loan. Again, we're going to go into more detail, so I'm keeping it a high level for a reason. Then the second path, which accounts for about less than 10% of our portfolio, is going through that foreclosure process when the borrower decides they will not or cannot work with us. So we take ownership of the home, or it is bought by a third party at auction. If we do end up taking back the property, which again in this economic climate is rare, then we will sell the home and exit the property that way.
So how do we do this? As Lauren mentioned on that top vertical about, fixing and flipping with that borrower, typically when a borrower is behind, they're ignoring a lot of their mail. So we have to provide a little shock to get them to communicate, because communication is such a key component in what we do. We do this by having an attorney send a demand letter, which is, when they see from the law offices of XYZ come through the mail, it typically gets them to respond, and it gets them to pick up the phone and call that servicer and say, I got this letter. What do I need to do to keep my home? And unlike traditional banks, which have a significant amount of red tape, if you've ever had to deal with a bank, I feel sorry for you. We work a solution which is called the trial payment plan with that borrower, which is, I'll call it a payment plan on training wheels. Give us 3 to 6 months, show us you can pay a certain payment for 3 to 6 months that we agree to, that we analyze their financials to make sure they can afford that payment. It doesn't make sense for us to throw a number out there that they can't afford. And then if they're successful, we'll continue to receive those payments for 6 to 12 months and then sell it back on the secondary market as a performing loan. So like we talked about fixing and flipping, this is that example of, we take a defaulted borrower, get them repaying, and that enhances the value of the loan to put it back on that market. And I'll let Lauren cover some of the benefits of investing with 70.
Yes. So when we talk about kind of that impact investing, really what we're talking about is you're going to be receiving passive income while making a difference on those borrowers that we are able to modify and work out loans with. You're diversifying your portfolio with a socially responsible investment. It's backed by real estate assets with ample equity, and we talk about that a lot in previous webinars. So this webinar isn't really focused on the nitty-gritty of our due diligence. We do have lots of those listed on our website, but we talk a lot about how it is backed by a physical asset with ample equity coverage. You're aligning your investment with your values and a purpose, and contributing to community stability by keeping borrowers in their homes.
And one thing I just want to add with this, there's other funds out there that do target just foreclosing on a borrower, and that's a strategy that can be successful. And you talked about our due diligence process, which we're not going to get into, but our underwriting models to make sure that we still meet all those requirements, and it's actually more beneficial for us to work something out with the borrower than it is to foreclose in many instances. So Lauren, you want to talk a little bit more about our Regulation A+ offering?
Yes. So we talked earlier about how we wanted to democratize alternative investing, providing both borrowers and investors with access and helping borrowers at the same time. So this is kind of what I meant by that. So we have a Regulation A+ offering that is open to accredited and non-accredited investors. So basically anyone can invest. It is a 4-year lockup, meaning your money is tied up for 4 years. The minimum investment is $5,000. We do offer bonus equity, bonus shares starting at $25,000, and we'll talk about what that looks like on the next slide. And then the preferred distribution is 8%. Now those bonus shares do increase that return. So we look at this slide. And so what we're saying is at 25,000, 50,000, 100, and 250, your bonus share percentage is increasing. So at $25,000 investment, you're getting 4%, 25 to 49,999. You're getting 4% bonus shares. So at a $25,000 investment, what this is saying is you're investing $25,000. We're giving you an extra $1,000. So you're going to be accruing 8% on $26,000. And then at the end of the 4-year lockup, you can redeem for $26,000. So you get to keep both. You're earning the 8% and you're also able to keep the cash value of the additional shares awarded. Some of the highlights of our offering is it is open to self-directed IRAs, so qualified and cash accounts. We do pay distributions monthly, and that starts within 2 months of your investment. So for example, anyone who invested or invests in the month of December, their first distribution will be paid February 1st. There is no leverage. So again, not only do we have that equity coverage, but there is no leverage in the fund. Up to 3 times collateral coverage. Again, that equity coverage. We get a lot of questions about what happens if housing prices fall. Is this another 2008? And really a big part of protecting the assets and is that equity coverage. So it is also not a blind pool. We're not raising capital for a development project that we're showing you pictures of, or a multifamily specific property that we have to raise a certain amount of capital to acquire. We have an active portfolio that is ongoing. We're adding assets and selling assets on a monthly or quarterly basis. We don't have fees. All offering expenses are paid by the sponsor, being Chris and I. And then from a tax perspective, it is a 1099 div. So I'm not a tax professional, but there is said to be some tax alpha there, as it is taxed as not ordinary income, but long-term capital gains, which are taxed at a lower rate. Again, total disclaimer to consult with your CPA, as everyone's situation is unique, and to see how that would affect you.
Yeah, and we're going to dive into the capital stack. I really want to harp upon that no fees, because a lot of offerings have those fees that are upfront, and the sponsor collects those fees and then goes through their capital stack, which here we'll illustrate our capital stack as well. Now, capital stack is order of priority, and typically you might see senior debt, mezzanine debt, and then investors are usually a preferred equity or common equity. At 7E, we do not have senior debt or mezzanine debt. So the analogy I like to think of is people have been to Disney World. You have the regular line and you have the fast lane. For us, our investors are in that fast lane. They're not behind anybody who can skip the line in front of them, like other offerings that might have some type of senior debt. I believe this is often overlooked. And I think it's really important for investors to truly understand this because it does play out significantly into any type of investment and factoring in the investment as you weigh an option, an investment, and that risk. So Lauren, you want to talk about what else sets us apart?
Yeah, so Y70, what sets us apart is really, it is that hands-off investing. So it is for people who are looking for that passive investment. We're managing every aspect of your investment, providing you with truly, that passive income where you're not dealing with the due diligence, the tenants, the termites, the toilets. You're just getting those monthly distributions. We have a track record of success and we are transparent. So not only have we done over 600 deals, fix and flips and managed 5 prior funds that have met investors' expectations or exceeded, never having missed a distribution. Again, past performance is not a guarantee of future results. But we also provide our investors with quarterly updates and regular reports are filed with the SEC. Risk-adjusted return. So we talk about this a lot in our other webinars. We go into our due diligence process and kind of really walk through the step-by-step on risk mitigation and what we do to mitigate risk. But we are carefully vetting each individual loan, targeting properties with significant equity coverage that allows us to offer those risk-adjusted investment returns and options. We like to say in baseball analogies that we hit singles and doubles. That is our focus. Consistency versus a grand slam every now and then. We want to mitigate striking out and are focused on hitting consistent singles and doubles. You'd think I watch baseball all the time. I do not. So it also our in-house team. So not only is our investor relations in-house, I see a lot of our investors are here on this webinar today. You can probably think and know that you reach out, you're going to hear from Tony or Katie, and you're probably going to hear back in a timely manner. You know who you're speaking with. It's someone who is working on our team in our products. And then on the asset management side, same thing. That allows us, as we're not outsourcing that, to work through those modification processes quicker, to be more on top of the communication, and again, not have to wait on a third party to make our decisions. So the last thing is it's really non-correlated to the stock market. So our focus is on that distressed mortgage notes that enable us to really purchase these notes at a discount, aiming to turn them into a profit, regardless of if interest rates are going up and down, if the housing market, it's not correlated to your typical Wall Street stocks.
Thank you, Lauren. Now we'll dive into my favorite, the case studies.
And this is where I will be peppering Chris with probably some questions, but I'll let him take it away for the most part.
Okay. Before we did have a question on bonus shares pop in. Do you want to answer that at the end, or do you want to tackle that before I hit into the case studies?
You know what? Why don't we tackle that at the end? I'm actually going to pull up because I think it's helpful to see a visual. I'm actually going to pull up a visual while you're doing this that I can share.
Okay. So this first case study, which I like to say is our bread and butter of that fix and flip process, which is a middle income home in Denver, Colorado, that we were able to acquire at a 30% discount and had a 36% loan to value. This was, well over a year ago, we had bought this loan and the borrower was 9 months behind. So a lot of people think a borrower gets 1 or 2 months behind, then, somebody's going to come knocking on their door and, grab them and throw them out. That is not the case. Typically, most of the loans we see are a year, 2, 3 years behind. So how do we fix and flip this loan? Well, to bring this loan current, we entered what's called a trial payment plan. I mentioned that prior. It is kind of like a training wheels plan of trying to get the borrower to make sure they can make those monthly payments. We were able to, in this instance, allow the borrower they were able to double their payment. And the reason why is they had a job loss during COVID. They were able to now get back on their feet and start making those payments again, but the prior lender would not work with them. They wanted all their money. And for us, buying it at a discount gives us that flexibility to accept those payments. And after 6 months of payments, they agreed to a loan modification, which is a permanent modification to the loan. And we wrap in some past due into the new agreement and, basically get the loan to start over at that point in time. So that's how we fix it. And then August of this past year, after they signed, we were able to sell this loan to another investor who I've known for 5 or 6 years, who took their self-directed IRA account, who actually is a note investor, and said, this is a perfect loan for me to buy, and he bought it. And that's the end scenario of where we flipped it. Okay. Our next case study was a loan. This is more of a loan, a cash flow loan for us, where a performing loan that we acquired that had a very low loan to value that was performing, and this was back last winter, and this borrower was looking to complete the renovations on this property. It was a high net worth individual, great credit, but was looking for a short-term loan to complete this. And based off of our underwriting process and understanding borrowers, we bought this loan and let the borrower, continue to make those payments until they're waiting to sell their business, which they did. And once they sold their business, they paid off their loan. So this is a type of loan where we'll acquire a performing loan because we like to have that balance within our portfolio, which typically will go 65-35 in either direction. We're constantly balancing it to have cash flow coming in the door as well as non-performing loans. This loan, this one was a tough one. This one, we acquired it at a discount with a low loan to value. But this borrower was feisty. This was a fighter. The borrower did not want to work with us. And, as part of some of these situations, this happens. It's not all rainbows and unicorns or whatever the phrase is within note investing with dealing with borrowers. We acquired this loan. The borrower was, as you can see, their last payment was in 2018. And the foreclosure process had been started on this, and the borrower was contesting that foreclosure process. After we purchased this loan, after we attended several court mediations trying to work things out with the borrower until we finally were able to. We were able to get the borrower to come back to the table. Really, the reason why was the borrower had an attorney who unfortunately passed away, and then had a new attorney come on board that was ready to settle. And in this instance, the borrower refinanced that property. And we did discount some of the payments that were owed in order to exit this property, because by exiting, it was the best case scenario versus continue to let this drag on. So here is a recent loan in Oklahoma. We literally closed this one within the past 30 days. And it's the end of the year. The seller was motivated to get this loan off of their books. The borrower took out a loan, financed construction of a new property. Borrower has made every single payment on this loan. The challenge they ran into was what happens in construction. If anyone's ever done a renovation on your home, nothing goes according to plan. If your contractor says, I'm going to be done by this date, it's always going to take 30% longer. No difference in this case. Construction wasn't completed, the loan had matured, and the lender did not want to extend the loan for the borrower. So we bought this loan at a 40% discount, and now literally yesterday reached out to the borrower, working out new arrangements with that borrower to get them over the hump to get it completed. And they actually already have a lender lined up for when to refinance them once they get everything resolved. So this is one that probably won't be in our portfolio for very long, but this is where we're able to take advantage of the inefficiencies of the bank, and also it being end of the year, where banks don't like keeping this stuff on their books for a lot of legislative purposes. So one thing I want to talk about on this case study is defaulted loans. And a lot of people think of, again, when we use that initial fix and flip strategy, people think, oh my God, these houses must be disasters. Like something you see on Hoarders or some of these other shows. Here's a perfect example, and you saw the last house or the ones in these case studies. These houses are not in a type of distress. It's the borrower who is. We acquired this loan in 2022 as part of a small portfolio of several other loans. The borrower was in bankruptcy. It allowed us to purchase it at a 32% discount, and loan to value, again, what we target, those lower loan to values. And how we do that is by purchasing loans that originated 10, 12, 15 years ago. We're not buying something typically originated last year when it's 10 years old. Properties have appreciated during that time. So in this instance, borrower, again, not a borrower who really was that willing to play ball. The trustee filed a motion to dismiss, which means throw it out of bankruptcy because they weren't paying. So they did. So what's the borrower do? They turn around and file bankruptcy again. So this borrower turned into a repetitive bankruptcy filer, but we were able to overcome that. And by working with the borrower finally realized, I can't afford this property. So we, instead of foreclosing, worked out a plan where they put the property on the market and immediately got it under agreement. And this property is actually sale pending, ready to close on December 23rd, I believe. And in this instance, as Lauren, if you remember way back when she showed us how we make money, one of the ways is they sell the property. And in this instance, we'll be able to collect the full amount that's owed to us. So we talk about loans we acquire. Let's talk about some of the brief due diligence on loans that we don't acquire and reasons why. So here was a loan in New Orleans that was originally proposed to us as a residential property. Now, if it is, I don't know anybody's residence who looks like that, but the loan actually was not a single family residence. And part of due diligence, we realized that. We realized the borrower was current on payments, but it was because the current lender accelerated the loan to make it look like the loan is current, even though the borrower wasn't making those payments. So after reviewing this, the borrower also had 3 foreclosures in the past. We decided this one does not fit our portfolio and goes back to that strategic component I mentioned earlier. Not only are we strategic on note investing, but we're very strategic on the types of assets we're going to look to acquire as well. And again, here's another scenario where, I think this is a beautiful looking home. And this was a loan that was in Texas that was part of a 3-package portfolio that we entered due diligence with, the seller. And it was the same borrower on all of these properties and able to pick it up at a slight discount because it had a higher interest rate, but also significantly, good LTV. The issue was in this situation, when we started reviewing title, which again, we talk about our due diligence, the seller forgot to mention to us that there were $1.5 million in judgments on these properties. That in Texas, because they were attached to a property during construction, would have to be resolved and settled as part of any foreclosure sale. And all of these judgments were actually greater or equal to essentially the value of these properties. What I think was happening was the borrower was getting money from the bank to build these, but actually never paying their contractors. So in that instance, of course, we're not going to buy something like this. So it's a situation where even though it looks like a beautiful property, it's not something we are going to buy and put our portfolio at risk on. So those are the case studies. And I'll let Lauren talk about if people want to learn more about us and reach out, how they can connect with you.
Thanks, guys. Yeah, and thanks, Chris, for kind of going through those. If you do have any questions about our offering, about some of the case studies, or want to learn more, feel free to scan this QR code. I know this is a crazy time of year with, we just Thanksgiving being so late. Christmas seems like it should be next week already, or is next week. So we still wanted to make time to run through some case studies. I'm happy to see that a lot of investors and potential investors have joined us to kind of show you how we do what we do in actual visual examples of portfolio assets in our portfolio, or that were in our portfolio. Then I'm just going to wish you all, we won't be doing another webinar till January, which you'll receive emails about probably at the end of this month, but wishing you guys all a happy holidays. Thank you for joining us today, and hopefully we see you on the next webinar.